And this is the Investing 201, Beyond the Basics. So we're going to get into some investments, things to consider when we're picking our investments, and get a little bit deeper dive. My name is Jeremy Jenkins. I'm a registered rep from Voya Financial Partners. Again, my title is a retirement education specialist. So I kind of go over these plans on a regular basis and answer any questions anybody might have. Just a quick disclosure while we get started here. I am here strictly education, not to give anybody any particular advice, but there is advice offered for you, and I will touch base on that as well. All right, so without further ado, let's get into what we're doing here. So to start out, we're going to talk about asset classes. So there's three basic asset classes, and we want to make sure that we're in the right one. And we're going to go into what the sub-asset classes are and make sure that you are in the right classes, you're positioned the way that you should be given your situations, and give you insights on investments that you may or may not have understood or gone over before. So now we're going to talk about, your particular asset allocation and why is that important? When you're considering your assets, you are taking a risk, but you're weighing that against a potential reward you're going to get. And when you're doing that, sorry, my computer's kind of frozen here. But sorry, a sound asset allocation. It's the foundation of your strategy. Sorry about that. Seems to be working now. But so let's talk about some of the tools you have when you are going to start picking your assets here. The first thing that you kind of want to consider is taxes and what are the ramifications they're going to have on you, and how are you going to manage it with your taxes, with your investments, and how it affects you. So what's the way forward? We're going to review your plan, talk about what investments and options you have in it, but then we'll take into account the fact of taxes and how you're going to handle them with it. You want to make sure that you get any questions answered along the way too. So I'll just remind you, you can pop up questions while we're going over this, and it can be at the end as well, whatever's more convenient for you. So we're going to go from basic asset classes. So, our standard cash, or then we go to bonds and stocks, but then we'll get into the sub asset classes. So what are each of those made up of? So we'll start out with stocks and the different types of stocks you have. So stocks are one asset class, one of the three: cash, bonds, and stocks. But we'll start out talking about what are the different types of stocks we can get into, and when what you want to be into that, right? So how are you going to determine the type of stock that you're picking? We've got the small, mid, or large capitalization. Now that just means how big is the company. And then there's investment styles. Are you growth oriented, or are you value oriented? So value means it's a good deal to buy it. You're getting it at a discount, so to speak. And growth means there's a lot of opportunity for that company to grow. Or you could pick it by geographic emphasis. And that could be, your focus could be domestic or international, or, getting the diversity in between either of those. So we'll start with the size of the company. And large cap, typically we're talking about companies that are bringing in profits of 10 billion or more. So huge companies. If it's considered a large cap company, there's a really good chance that you have actually heard of that company or know something about it. So it's a large company. It's exactly what it says. Then you go into mid cap. Now, mid caps you may or may not have heard of. Those are going to be companies that are earning between 2 and 10 billion. So huge numbers. I mean, those are big numbers, but there's not as familiar to you. They're not the big names. They're not like a Google, which would be like a large cap. And then you get into small cap. These are going to be less than 2 billion. And actually, you may not have heard of these companies before, but they are what keeps America rolling is these small cap companies. Now, we'll talk a little bit about growth versus value, right? So, growth are companies whose earnings and profits are growing. There's that potential for growth out there. Um, the share price is going to be higher than its current earnings, again, based on you believe it's going to grow or catch up to those earnings, or I'm sorry, catch up to that share price. And so you might pay a premium for that because there's a lot of hype into it, but you're paying that premium for that possible growth that you're getting. Kind of going back to that risk versus reward idea again. It's kind of the underlying factor of all these investments. Now, value companies are companies that are undervalued or sometimes overlooked, right? So buying it on sales, like buying it with a coupon, but they're poised to grow. You're just getting them at a good deal. So buying something that's going to be big before it's big. Now, when you are reviewing your asset classes, you might see these boxes that are on the page when you're going over the plan. Now, what does that mean? So you can see the little grid here. Is it a small, mid, or large cap company? This would be a large cap company. But how is it? Is it a value company or a growth company? And of course, there's a blend, which is a little bit of both. So in this case, this particular fund is a large cap blend fund. So that's what this box means, and that's what it's relating to. So when you see this next time, you'll kind of understand what that means when you're looking over the fund that you may are already investing in or thinking about investing in. Now, picking geographic emphasis, how global is going to be something that includes the U.S. International is outside of the U.S. Now, where are they investing? Is regional is going to be a Far East and then the country. Region is like a far, like a bigger area, so Far East. But a country would be something in that region. So, like in the Far East example, it would be Japan. And then how are you investing in this segment of the market? So international small cap, that would be a small company that's outside of the US in that example. Now for the bond piece. So we kind of broke down the sub asset classes of stocks. Now we're going to talk about the sub asset classes of bonds. So you can see there we've got treasury bonds, corporate bonds, and municipal bonds. All of them have their differences, and we'll kind of get into that right now. So how do we break down bonds, right? So you're going to look at, what is the credit risk? That is, what's the credit worthy? What kind of risk? You think about your credit score. I'm not sure if you're familiar with credit scores, but they're on a scale that goes up to 900. So if it's got a 900 score, there's not much of a risk involved in somebody lending a loan to someone with a 900 or high 800 score. But conversely, if you've got a lower score, you've got that higher risk, and you'll end up paying for that. And you'll see how that comes into play in a minute. The other way to break down bonds is their maturity. So when do they come due? When are they going to pay out the principal? And then what type of insurer is it? So is it a government or is it a corporate entity that's issuing these bonds? So you're looking at quality and maturity because that's both going to affect the price of that bond. So if it is high quality, that's what this red box is indicating, better than low or medium. And then when is it coming due? Is it sooner or later? That's what this box is referring to there. Now, those are your bond kind of breakdowns. What type of cash is there, right? So we've got different types of cash, believe it or not, and we'll go into that in a minute. So there's short-term investments. That would be things like money market funds, government funds, and stable value funds. And then you can break them down by how are they issued. So are they bank CDs? Are they issued in the form of mutual funds, or even managed accounts? So all of these types of cash can be found in those types of funds or CDs. And we have to weigh the risk for each asset class. So how does it bear out on your portfolio, right? So we've got stocks, but you want to think about, okay, what kind of market is it in? What kind of company is it? What sector is it? And where is it located geographic? Those are kind of the risk that you want to consider for stocks. And then bonds, again, what is the interest rate? What's that rate risk? And what's the credit risk? How has that company paid its bills to this point? And then we've got cash. And for cash, the biggest thing that affects cash is inflation. Again, that's very topical as of late, talking about inflation and how it affects you. Right now, what's topical? The price of eggs, inflation affecting them. Looked like I had a question there. I'm going to pause and see if I can answer that. So the question is, why are mutual funds cash? So it's kind of the other way. Why is cash in a mutual fund? So if you're investing, you can invest in a myriad of different ways. A mutual fund just makes it easy because you get a lot of types of different things in a mutual fund. So if you want diversity within a cash investment, you would invest in a mutual fund that's going to purchase, different bank CDs or different cash entities like that, stable value funds. So you're not in just one fund or one CD, you're in a bunch, and maybe you can spread out, you're getting diversity that way, spread out your risk. But typically you would invest in something like that when you're putting your money on the sidelines, but you want it to earn a little bit more than it would be just sitting in pure cash. This way you can earn a little bit of interest. It's at a safe investment. But that's why you would invest. That's why a mutual fund might have cash type products in it. But good question. Thank you. Now, this is kind of what we call our quilt. And what you can see here is the years. So it goes back a few years here. And what has performed the best every single year. Now, you can see no one thing has been the best every single year. And that's why we focus on diversity, right? Because in this year, if you put everything in your treasury bond in 2008, you would have done really well. But if you look at the year right after that, you didn't do so well. And, you can't try and time the market. You never really know what's going to go on. So you want a diverse portfolio that means a little bit of everything, but maybe you're going to weight it one way or the other, depending on your timeline and your risk tolerance. But that's why we want to look at this. This is why it's important, is because you can see every single year is going to be a little bit different. You can't really time the market. You just want a diverse portfolio. That's the best way to do it, investing for the long term. Now, when you are investing, we talked about, the assets. Now, how are we going to allocate? I just said we want that diverse portfolio. But if we're younger, or we have time or the risk tolerance, we can afford to take a little bit more risk in our portfolio and hopefully enjoy that better reward that it's going to give us. All right. So why is that important, right? Factors explain the variation between portfolio performances. You can see asset allocation is the biggest factor. Not market timing. That's surprisingly not the lowest, but almost. You've got the other things that add up to that, and security selection. But asset allocation is really what's going to explain that variation between portfolio performances. So it's huge. You want to be properly weighted for your particular risk tolerance and timeline. So if you look at this, you can see you're taking the higher risk out here in these global and international type investments, but you've got that higher return. Now, that's not to say that you want to be all in out here. Again, we want that diverse portfolio. We want a little bit of everything, but heavier weighted out on this end when we've got time to deal with those ups and downs of the market, and hopefully reap that higher reward. And then as we get closer to retirement, again, still diverse. We want a little bit of everything, but we're moving down closer to this end. Think of this as like a glide path into retirement. So a stable portfolio here. But something to consider here, again, going back to that diversity, how long is your retirement going to be? You may be in retirement 20, 30, 40 years. It's not unusual for people to live to be 100 anymore. So we still are going to want to have investments out here, even in retirement. So that diverse portfolio, but asset allocation based on your risk tolerance and time horizon. So what kind of investor are you? Huge question that we really want to focus on after we've talked about these investments and how they're going to perform. We've got a great quiz. It's about 8 questions. If you go to go.voya.com/quiz, this is just a quick quiz, like I said, about 8 questions, but it's going to point you in the right direction based on your answers. So how you answer is going to say, okay, how you answered, you're pretty moderate. This is how you might want to invest. It gives you the results right there. It's a great way to get started if you're just kind of new to this or trying to figure out, where do I begin? Don't let it be daunting. We've got tons of resources to help you out. And again, that quiz is a great place to start. So which portfolio might be right for you, right? You can see a little bit of the difference. And these are kind of exaggerated numbers, but to show you a visual of what it looks like. So a conservative portfolio, 59% bonds, 17% stable value, and 24% stocks. That's a conservative portfolio. You can still see, though, we have quite a bit, a decent amount into stocks here. So that's diverse. We want that. And then we go up here to our aggressive portfolio. So we've got the bonds and no stable value here. Again, I think that you should always have some diversity. These last 2 don't have that cash portion, but it's really to show you or highlight what your portfolio would look like. If you're super aggressive, you can see you're going to be 98% into those stocks. Now, the other thing to consider is rebalancing, right? So you can kind of see how your portfolio, excuse me, how your portfolio has performed. If you started out at 50-50 every year, how it would go here. So you started at 50% in 2000, and then the next year, stocks outperformed bonds. So now it's at 53%. And the next year, stocks outperformed. So now it's 61%. But if you wanted your portfolio to be 50% stocks, 50% bonds, you would have to rebalance, which means you'd have to sell some of these stocks and buy some bonds. That's what we want to consider going down the line. Is if we're picking our own investments, we want to revisit this on a regular basis, rebalance as required. Because again, if you have a 50-50, 60-40, whatever it may be, and one significantly outperforms or underperforms the other, at the end of the year, you're going to want to rebalance to kind of get back to that allocation that you started out with. So remember to rebalance. That's what this says. It doesn't eliminate the risk of losses, but again, it all goes back to what is your risk tolerance. And then from there, you're going to pick out your allocations. And how do we stay within those allocations? We rebalance probably at least annually, maybe even as often as quarterly, depending on how the market's going. Market timing. This is really just a bad word. It is so difficult to time the market. I would argue that nobody can really time the market. And let's just say you can time the market one time. The thing is, you got to time it a second time to either get back in or get back out. So not only do you have to do it once, you have to do it twice. Because if you're buying low and selling high, Those are two separate things. So you have to get it right twice. I would argue that it's virtually impossible to do it once, let alone twice. So stay away from market timing. Just get a diverse portfolio. That's really the key. Diverse portfolio with the asset allocation that's kind of matches what you are looking to do. And this is really, I think, a very great graph here. When we're investing for retirement, we're investing for the long run. You can see how it performs here. It goes up. Sure, there are some downturns. There will be. It's the way the market goes. But for the most part, if you got in, there's no 30-year period here, which most working careers are 30 years. There's no work for 30-year period here where the market went down, right? So we are investing for our retirement in a long term. So always keep that in mind, particularly when there are, the headlines that want to catch your attention and be so negative. Now, when we get into retirement, we're going to start withdrawing. I think it's not really talked about enough. That's my own personal opinion, how hard it is to go from saving, save your whole life. That's been your mindset. Save. Now we get into retirement and we have to think about spend. How are we going to spend? Well, there's a strategy to save and there's a strategy to spend. So where are we going to take that money from when we get into withdrawal? Again, timing of returns matters. So where are we going to take it from? Let's look at this sample here. We're going to assume $1 million portfolio with 4% withdrawals and the average investment return over 10 years of 5%. So you can see in this one, we have losses in the early years, right? So we lost 20, 10, and 8 in the first 3 years, respectively. Then we started to pick it up a little bit. But with our withdrawals at the end of 10 years, we're at $739,000. But what does that look like if we go in the reverse order? Right? So we start out with good returns and then it gets bad at the end. Well, we're with over $1 million from where we started, 1.1 to be exact. And again, because of the timing. So that it has to do with asset allocation. So this really highlights why you want to keep your asset allocation where you want it, but also rebalance that on a regular basis. All right, you can see the difference. It's the same returns. It's just flip-flopped here. The big difference though, because when you get the 20% loss, but you're also taking that 4% out, that's a 24% loss. And then next year, a 14% loss. Whereas in this case, we got the 24% return. We took 4 out. Well, we still were up 20 for the year. That's gonna make a big difference. That's the big difference right there. So when we're taking that money out, asset allocation is always going to matter. Where are we taking it out? And we got to keep rebalancing along the way. So we have to find the right tools to pick make our choices here. So we're going to go over prospectus and annual reports. So how are we going to pick these funds that we're going to be picked in? We'll talk a little bit about alpha and beta. Manage your tenure. So why does that matter? I guess that's pretty kind of self-evident why it matters. We want to have a manager managing the fund that kind of has done it for a while, knows what he's doing. Or he or she, I'm sorry. And then is it actively or passively managed? Those are two different ways of managing portfolios that we're going to want to take into account. All right. So I say there's a time to be active and passive, right? There's a time for everything. So active management is a manager that's out there moving funds as the market dictates, right? And passive is just you may have heard of an S&P 500 index fund. That's just a fund that has all of the S&P 500 companies in it that mirrors what the S&P 500 does. There's no management in it. It's a mirror. It does whatever the S&P as a whole does. It's very passive. So there's reasons why both are good. All right. So how do we measure those? How do we measure the returns? We've got Morningstar ratings, we've got Lipper ratings, and then we've got benchmark indices. So, what is it? The Morningstar rating uses 1 to 5 stars. Lipper is based on a peer group comparison, and the benchmark is, benchmarking it to other funds like the S&P 500 or the Barclays or the Wilshire. All right. So, why are either of these helpful? Well, the Morningstar is helpful because it kind of gives objective ratings based on past. So you may have seen when you're looking at investments that past performance is not indicative of future performance, and that's true. But I think it's always good to go back and look at how did a fund perform over the past, and if it's been around for a while, how did they handle some things that went on in the market? It might be a little bit of an indicator of the future. And then we've got Lipper ratings. So these are independent experts, ranking similar funds. So they're only looking at, say, bond funds, for example. So that's why it's helpful, because they're experts in their field, kind of grading their own specialty, if you will. And then benchmark. So why is a benchmark effective or helpful? It really helps you figure out what to compare your fund to, right? So you can't really compare a stock mutual fund to a bond mutual fund, because that's apples and oranges. But you could compare a large cap fund to another large cap fund, like the S&P 500, for example. So how did your large cap fund fare versus the S&P 500 as a whole? That is a great way to grade it. So that's why it's helpful. All of these are helpful ways to kind of figure out how your fund or a fund that you're looking to get into has performed, right? And you want to look at a range of returns. So not just like, okay, how did it do last year? How's it done this month? But what if you look at that? Let's look at that right now. Let's say, what did the best last year? Well, ABC fund definitely did better than XYZ. All right. But the year before, or I'm sorry, 10 years ago, for over the last 10 years, they've been pretty equal, right? So which one's really better? Well, for 5 years, ABC. For 3 years, ABC. Last year, ABC. Over the life, it's been ABC. But this is why it's important. We're really looking at long-term gains, or long-term results. Another way to look at this and kind of grade it is we're looking at these fun fact sheets. We talked about these graphs that are in there at the beginning and what they mean. So that's going to be helpful. There's lots of great information in these sheets. Up here in the top left corner, it goes over what is the fund's objective and strategy. What does that fund manager hope to accomplish with this fund, right? And it tells you, what are they limited to? What are they investing in? How are, very helpful information when you're picking your fund. And then we've got this graph, right? So how is it allocated? And then the fun fact sheet. So what is it investing in? So in this particular one, we've got 45% into the US stock index and 21 into the international. So this really breaks down what it's in, its top 5 investments. And then if it's got bonds in it, what grade are they? Are they, AAA would be good, or below B? What kind of bonds are in this fund? And then what kind of, what's the expense ratio like, and their fees like? Very important information when we're picking a fund, because all those are going to have an effect on the performance of the fund. So if you're looking to allocate into a certain asset class, say you only want stocks, well, this may not be the one for you because it's got, you only want US companies. This may not be the one for you because you've got this international port, right? In emerging. So maybe you want something else that's a little bit more heavy US, or certainly all US, whatever it is. And then what kind of fees are involved in this? You want to make sure that the fees aren't exorbitant, especially comparing it to another fund of a similar type. So now we'll get into what are the expenses, right? So Fund A and Fund B, we're going to put 10,000 into each. Now, what my rate of return on about is 8% on both of those, but my expense ratio, you can see, is quite a bit less in Fund A than Fund B. And so after 10 years, how has that affected my investment? Well, you can see it's affected it quite a bit. If you look, it's almost 15% of your original investment difference between Fund A and Fund B. So it really makes a difference. You want to look, we're assuming here that Fund A and Fund B are invested similarly. Why would I pay more fees for Fund B when I could pay less in Fund A? Now, dollar cost averaging. This goes into how or when are we going to invest into these funds? Do we want to just, okay, I'm going to wait till I get 5,000, I'll throw it in the market then. Or do we want to do just every time I get paid, I'm going to put a little bit in there, right? This shows dollar cost averaging. This is you're putting in $100 every month. So in January, you put in your $100 and you got 10 shares. Now, February, you might think it's bad because the market went down, but now your $100 bought you 14 shares. That seems like you got it on sale. Same in March, same in April. It's coming back up a little bit. But at the end of those 5 months, you've got a $500 investment. You've got 64.6 shares at an average of $8, right? So yes, you bought some at 6, bought some at 9, and some at 10, but on average, you own these investments at $8 a piece. That's dollar cost averaging. So going back to, if I had that $500 and I just threw it in January, I'd only have 50 shares, which is kind of worst case. The best case, I could have done it in March and I really would have lucked out. But the dollar cost averaging takes away that market timing aspect of it, and it kind of averages out here. $8 is not so bad when you consider some of these other prices. But dollar cost averaging is just the easy way to do it. It's how you're not going to market time something. Now, let's make it less taxing. Oh, I like that. But how are taxes going to affect you, right? The first thing is, how are you going to contribute into these funds? We've got Roth 401ks and traditional 401ks, and they're basically the opposite of each other. So in a Roth, you're going to pay income taxes on contributions as you make them. You're paying the tax today. So hopefully you can have a tax-free withdrawal in retirement as long as it's been in that account for 5 years and you're age 59 and a half or older. So tax-free retirement sound really good to you, and you're not forced to take that money out like you would be in a traditional. They have the RMD option. Now, the traditional is you're not going to pay taxes today. It may even lower your taxable income. So if you're in a high income tax bracket, that might be super helpful today. But you're going to pay taxes when you withdraw that money in retirement. And I was saying before, in the traditional, you're also going to be forced to, whether you need it or not. And once you get to retirement age, they start making you take a certain amount every year as well. So why would you do one or the other? What's more important? Well, you have to really think about what is your tax bracket today versus what's it going to be in the future. Well, who knows what it's going to be in the future? Does anybody know? We really don't. The tax bracket could be all way different, particularly if you're younger. We're talking 30, 40 years in the future. What are taxes going to be like then? I don't know, right? But if you're younger and that grows, you pay taxes today. Now it's going to grow and grow and grow, and you aren't going to have to pay taxes on any of those earnings. So that could be beneficial as well. But going back to traditional, maybe I'm in a really high tax bracket and anything I can save in taxes today is going to be a super, super helpful to me. And I don't know what the tax bracket, it may be higher, maybe lower in retirement. So I'm going to take what I can get today. So those are kind of things you could look at for you. Talk to an advisor, be it financial or tax advisor, and find out what's good for you. But what kind of strategy do you want to have? You definitely want to consider taxes when you're doing this. So that being said, we've talked about all the asset classes, the sub-asset classes, how to pick them, what's important when you're thinking of those, how to take into consideration taxes. Now let's talk about what you have available in your plan, right? So there's path one. It's a very easy path. It's set it and forget it. You don't have to put a lot of thought into it. So maybe you signed up for this investments 102 or 202 trying to learn more, but really I just bored the heck out of you. Well, I hope I didn't, but maybe it's just not for you. Set it and forget it might be the way for you to go. And I'll go over that. Just makes it a very easy option. But maybe you signed up for this because you really wanted to learn more about investments. You dig it. You're awesome. You're gonna watch this on a regular basis. Subclasses, all that's important to you. You're gonna rebalance it. Path two is a great option for you as well. And then path three is really great for when you're near or in retirement, and we'll talk a little bit about what that entails. So path one, make it easy for me. It's that set it and forget it. So how does it work? Let's say I want to retire 20 years from now. I'm going to pick that target date 2045 fund because that's roughly 20 years from now. That fund manager is going to manage that for me to retire on or about 2045. I don't have to do anything. I picked that fund today and I just keep investing in it. That fund manager is doing everything else. Today, being 20 years out, I'll be fairly aggressive. That manager will get more and more conservative as time goes on, and I don't have to do anything at all. Another option would be risk. So maybe you just want to pick your fund based on your risk. You know that in general, you're kind of middle of the road type person and investment, or maybe you even took that quiz I talked about earlier, and it says you're a moderate risk person. You just pick this moderate risk, and you're going to invest moderately throughout your whole career. So these set it and forget options are great. Excuse me. They're great because you don't have to put any thought into it. The fund managers do all the work. You made your choice and you're done with it. So now path two is probably for a lot of people that are on this call. You're interested in investments or want to learn more and want to manage this and get everything you can out of it. Tracking this is super interesting to you. You have these funds to choose from. And we talked about it. We got our small cap, our large cap, mid cap, all cap. We've got our international funds, fixed income. We can get some alternative funds. When we're talking about alpha and beta, trying to get those real assets. Those are all the funds you have to choose from, and you can invest in any or all of those. Make changes as it comes for you, whatever you need to be. You have those to choose from, and then there's path three. So path three is, like I said, I think it's very. You spend your whole life save. I need to save for retirement. Then you get into retirement or close to it, and you spend. That doesn't make any sense. I can't even wrap my mind around it. Well, this is going to kind of put you into a fund that makes it easy for you to start taking and spending from that fund. So do you want to preserve your capital? What's important to you? Or do you want to make sure you've got that inflation protection? Or maybe you still want to get a little bit of growth while you're in retirement. Whatever it is, you pick the fund you're most comfortable with when you're in retirement, and that's what you can do. But they're great funds when you get into retirement, again, because I think it's kind of difficult to go from save to spend. A fourth option, if you will, is the Schwab Personal Choice Retirement Account. This is really going to open it up for you. So if you're investing in your own thing and you want more than these funds right here, what we have available to you is the Schwab Retirement Account. This, you're able to move a portion of your account into this, and it opens up all the investment universe for you. I think it's over 15,000 funds, stocks, bonds, alternatives, ETFs. It's all available to you to invest in. You're not limited to just those other ones. So if you're really into investments, you want lots and lots of choices, or maybe you just want to be in particular individual stocks, this is the way to go, and it opens that up for you. Again, just a quick disclosure on all of the investments I've talked about. They are all in the market. There's no guarantees in any of them, so they will fluctuate as the market goes up and down. So what are the next action steps? Well, I think number one is ask questions if you have anything after this. But after this, if you didn't ask a question today or something comes up, there's advisors available to you at no cost to you. In fact, we highly encourage you to reach out to them. There's no cost or obligation to get to talk to these people, but excuse me. It gives you a chance to have a one-on-one with an investment advisor and kind of help you out with your plan, point you in the right direction, help you get started, answer any questions that maybe I didn't answer for you. Just call this 800 number. Just takes nothing but your time. It's great opportunity for you to talk to a professional about your retirement plan and answer any questions you might have. Maybe you just want to do it on a one-on-one basis. That's the time to do it. I highly encourage everybody to do it. If you want to make a financial plan or schedule a one-on-one session, this is the best way to do it. Scan that QR code up there. It's going to give you that complimentary appointment with VFA. You can go to govoya.com/ABA_RF1. But again, scanning that QR code is going to be the best way to do that. Or you can call the 800 number and talk to our financial advisors as well. They're really going to help you out with that financial plan. Again, if you've got just more questions after today, super helpful for you to go and do that. But that's it. That's all I got. And you can do it. It's not that hard when you get back down to it. If I could just go back to that slide, that 91% of it comes down to how you're allocated. So allocate to what your risk tolerance is, and you'll be okay. I'm going to open it up for any questions anybody might have. Nothing at all? Again, feel free to either raise your hand, I can unmute you, or you can type in a question. I'll be on for another minute here. There's a question. Can you talk about annuities for a bit? So what is an annuity? An annuity is a type of insurance product. There's lots of different types out there, but underlying investment is protected by an insurance asset. So it can be helpful at different stages of your saving or retirement. And again, there's different types of annuities. There's fixed annuities that will give you a guaranteed return. That would be like a cash type investment. Or there's variable annuities that will give you some sort of, you could get guaranteed income in retirement. Now, these, because of the insurance aspect of it, there are higher fees attached to this than there would be in other type of investments. Again, because they are such a varied asset class, I can't go into the specifics because annuities are very wide ranging, but that it's just an insurance type product that has typically higher fees in it. Any other questions at all? All right. Well, I'm going to stay on for another minute or so to make sure nothing comes up. I'm going to go back a couple slides here just to, again, if you would like to schedule to talk to an advisor, scan this QR code. It's going to put you in touch with them, make it very easy. Again, or call this 800 number, put you in touch with that one-on-one. Highly encourage everybody to take advantage of that. It's free offering for you. Another question is something Voya reminded me was that trading in retirement accounts does not result in reportable tax gains or losses. Not true of a non-retirement account. That is true. So in your 401k, it's not, you're getting taxed when you either put it in, if you're doing the Roth option, or you're getting taxed when you take it out. But in the meantime, it's not a taxable event. You can change your investments. It's not taxable in the meantime. So that is a great point. Thank you very much, William. All right. Well, thank you, everybody. I super appreciate your time this evening. Good luck to you, and you can do it. Go ahead and schedule that one-on-one call. But have a great rest of your night. Take care.